After shifting from SCHD to Rowe Price, TROW, this year, I've been using dividends, covered calls, and strategic share additions to build up my position. And today, I'm making another move. I'm Patricia Saylor, managing partner of Saylor Financial Fundamentals. I had been holding off, hoping for a bounce in the share price before writing a new covered call, but it hasn't happened. So I went ahead today and sold a $95 covered call expiring on June 20th. The timing is tricky. I'm not sure yet whether this expiration will fall before or after the next ex-dividend date. If it turns out to be before, I'll likely roll the contract again to make sure that I capture the dividend. This is one of the trade-offs of moving from ETFs to individual dividend stocks. There is more volatility, more opportunity, but a little more hands-on management. By the end of this video, you'll see where I stand on this position and what I'm watching next. Let's walk through the numbers. The last trade I made on Rowe Price was on March 21st, 2025, when I sold a covered call with a strike price of $95 and brought in $154.34. That contract expired worthless, and I've left the position alone since then because I've been hoping for some recovery in the share price so that I could sell another covered call at a higher strike. You might recall that I started buying these shares when they were pretty expensive, up at $117 a share. And I have brought my average investment per share down to $115. And then it dropped so much that I really wasn't able to sell covered calls above my break even. So I left those shares alone to wait for recovery, but decided to start trading with another small position on TROW. After the last dividend payment in March, I bought 110 shares and I paid $92.58 a share for them. That's when I sold the covered call with a strike price of 95, hoping that the shares would be called away from me, but they weren't. So I've decided today that I'm going to sell another covered call with a strike price of 95. You can see that I have 360 shares of Rowe Price. Last dividend payment was in the middle of March. I don't know if the next dividend payment will be before or after the June 20th options expiration date, but I'm going to sell a covered call expiring June 20th, and then I'll put in an order to roll it to July if it goes in the money. This $135 premium is about the same as the dividend payment. So even if these shares go in the money and are called away from me and I can't prevent the assignment of the contract, I'll still have earned the same income that I would make from just holding the shares and waiting for the dividend. The order filled at 155. You'll notice that compared to the last covered call that I wrote on TROW, even though I used the same strike price of $95 and brought in the same amount of premium of $154.34, the contract that I set up on March 24th has a 27-day holding period, and the contract that I just set up today has a 50-day holding period. So based on the $92.58 a share that I paid for the shares I'm using to cover this call, I have a much lower annualized rate of return on the contract that I wrote today. And that's because the share price has dropped from $92.58 to $88.61. So based on the lower share price, I have a much lower annualized rate of return. In order to make the same amount of premium on the contract, I have to hold it for 50 days instead of 27 days. If the share price rises to $95 before this June 20th expiration, there is a chance that the shares could be called away from me before I qualify for the dividend, and I would really like to keep that dividend. So I'll be keeping an eye on this contract and making sure to roll it out to July. to avoid having these shares called away before the ex-dividend date.